I'm Charlotte McLeod with investingnews.com, and here today with me is Edward Sterck, Director of Research at the World Platinum Investment Council. Thank you so much for being here. Great to have you as always.
Charlotte, thank you for the kind invitation. It's always great to chat.
Great to have you back as always, and it sounds like it's the perfect time to have you. We were talking just before we turned the camera on about how you just wrapped up London Platinum Week. So I wonder if you can start by sharing any key takeaways that we should be aware of.
Yeah, no, absolutely. I'd be delighted to. So London Platinum Week, it's one of three kind of platinum weeks in inverted commas around the world. You've got London in May, Shanghai Platinum Week in July, and then New York Platinum Week in September. And it's really, those events are kind of opportunities for the whole of the industry globally to come together and chat to each other and try and discover what's going on in the PGM space. And we're not just talking about platinum, but also palladium, rhodium, and ruthenium, iridium, and osmium, and so on. So I'd say in terms of the event itself, the view last year as a contrast was extremely bullish. Prices began to move on the Tuesday of Platinum Week and have kind of doubled since then. Where things stand today, I would say, is kind of a little bit mixed. People are still trying to work out what they've learnt. We do see some potential headwinds to demand from the automotive space related to the conflict in the Middle East. But on the other hand, we've discovered that there are some new end uses for PGMs in things like AI that we possibly haven't really been aware of before. Not yet enough detail really to kind of accurately quantify what that demand pool looks like, but could be a good accelerant for platinum, for iridium and ruthenium in particular. And I think if we think about the broader picture from an investment perspective, we saw strong investment demand for bars and coins in the first quarter of this year. We saw the precious metal rally obviously lose momentum kind of in the sort of January time period, but prices have remained actually pretty elevated and at pretty attractive levels. I think the conflict in the Middle East has been pretty important in terms of effectively driving inflation, and so therefore expectations for higher interest rates around the world. And as a result, particularly talking about Federal Reserve rates in the US, that leads to a theoretical outlook for a stronger US dollar and so therefore weaker US dollar commodity prices. And that's kind of what took the wind out of the sails, if you like, for the precious metals rally. That said, I think there are some challenges associated with that outlook. Inflation is exogenous. It's being driven by the conflict, by high oil prices. And the US balance sheet is still extremely stressed. You've got debt to GDP at the highest level ever, higher even than at the end of the Second World War. And we've got about a 70 basis point shift in terms of Fed Reserve rate expectations to now from just before the conflict started. Every basis point equates to roughly about $3.3 billion of additional interest payments alone for the federal government in the US to make every year. So it's just putting extra strain on the US balance sheet, and I think we could see a scenario where we see later this year that kind of motivation behind switch to monetary type assets, particularly precious metals and platinum that we saw come through in the fourth quarter of last year. That could return again in the second half of this year and be a big driving factor behind sort of increased investment flows.
Definitely a lot of factors at play moving the market right now, and we'll get into those in a little bit greater depth. The World Platinum Investment Council's Q1 report just came out, so that plays into this too. And one point I wanted to start by pulling out there is that the market was in its first surplus in 6 quarters, I believe. So I wonder, you've talked a little bit about market dynamics. Can you share what led to that surplus?
Well, there was a couple of things really. So we've got, we had increased supply year on year in the first quarter of this year. In terms of mine supply, that was largely due to, on a comparative basis compared to Q1 last year, mine supply was heavily impacted last year by flooding in South Africa. And so, on a relative basis, we've seen a stronger result this year because we haven't had a repetition of that. But you've also had some other factors like deferrals of planned maintenance, which historically have always occurred in the first quarter, to later in the year. So it's just kind of taking away a little bit of that seasonality. Q1 is normally very, very weak from a mine supply perspective. and then you tend to see progressively higher output as the year unfolds. We've also got some growth in recycling supply. So that's principally price driven, effectively with higher prices. Things like lower grade spent auto cats are more economic, and so you can put more of them through your smelters and refineries, recover more metal. That's a fairly temporary thing, we think. But we are taking a conservative view, and we assume that looking at the year as a whole, we see recycling increase by around 9% year on year. So price-led growth, as I said. On the other side of the equation, demand's actually been pretty good, in fact, in most segments. But the exception really is in terms of investment demand. So there's two things that we capture within our investment demand flows that were negative in the quarter. Firstly, with the kind of stalling of the precious metal rally, we saw some outflows from ETFs. I think that partially that was profit taking, but actually it was probably also a bit of a kind of liquidity call, with anyone with any kind of energy exposure needing, I guess, kind of call on cash to cover or support margins for their energy investments. Precious metals, and this isn't just platinum, it was kind of across the board, were used as a source of liquidity. So those outflows obviously count as a negative demand factor in the quarter. We also saw a little bit of an easing of the trade tensions in the US. Exchange stocks linked to the CME built up significantly last year to really elevated levels, because you saw strong contango in the forward curve due to fears around potential tariffs in the future. And so just with a bit of an easing of the kind of trade tensions, and given that you've still got things like extremely elevated lease rates in the European market, in the London market, if you could, it made sense to take some of that metal out of the CME warehouses and put it back into the lease market. Now, I think the key thing is, whilst we had that surplus in the first quarter, and it was related to those ETF and exchange stock outflows, that was not enough to really kind of take the tension out of the market. So if we look at those lease rates, and you look at things like the backwardation in the London OTC forward market, we've still got elevated lease rates, we've still got backwardation. So even that release of almost 500,000 ounces of metal back into the market hasn't been enough to really satisfy the market tension. We've still seen those above ground stocks that have been depleted over multiple years of deficits just aren't being replenished effectively to the level needed to really bring total liquidity back to the market and ease that tightness.
Right. I see what you're saying there. And on the investment side, I thought it was pretty interesting to see the divergence there between bar and coin and ETF demand. I wonder if there's anything more you could say there in terms of what we were seeing geographically, regionally, any takeaways that we should note there?
Yeah, so bar and coin demand obviously is, kind of more retail led. We started the year with a lot of enthusiasm for precious metals, really continuing, that Q4 sort of excitement last year. And so that translates into really strong bar and coin demand. China was a big driver of that, but we also saw strength in other markets as well. That demand was particularly robust in January. It did taper off as we went through the rest of the first quarter. I think the kind of end of the people were kind of investing to a degree on the trend in precious metals. As the steam came out of that rally, a little bit more conservatism, people thinking about, well, where is value here? As price came back a bit, we have seen some return to bar and coin demand growth, as you can probably imagine. But in terms of ETFs, like I said, typically it's a bit more institutional in terms of the kind of holder profile. And I do think that the kind of liquidity call was a factor in seeing those ETF outflows.
I think importantly, despite this surplus in Q1, still looking at an overall deficit for 2026, although lower than last year, but still a deficit. So I wonder if you can talk a little bit more about how the trends that we have seen in the first quarter could change over the course of the year to create that deficit. I know you talked about how mine supply was a little bit unusual in Q1. Anything you would add on that note?
Yeah, so on the mine supply side of things, I think we've got a pretty flat outlook on a year-over-year basis. So, actually very, very muted mine supply growth. It's just the seasonality shifted effectively from having weak first quarter to smoothing out production for the course of the year. In terms of the demand side of things, we see actually fairly good demand in terms of the industrial demand and jewelry demand, with the exception in jewelry terms of a little bit of weakness in China. But automotive demand, we've actually scaled back our vehicle production numbers by about 1 million units relating to higher oil prices and so on. But in fact, we've actually ended up increasing our automotive demand for platinum on increased heavy duty production forecasts and things like that. So the kind of automotive, industrial, and jewelry side of things is looking pretty strong. I think the key thing really is reflecting on what happened in Q1 and those ETF and exchange stock outflows. We're expecting investment to return and recoup some of those Q1 losses, and that's what results in the forecast for a deficit of about 300,000 ounces for 2026. And I think, as I kind of hinted to in the opening statements when we were talking about London Platinum Week, some of the motivations behind that investment flow is probably going to be linked to concerns around the US dollar and the fiscal balance sheet, the federal balance sheet in the United States.
The other point I wanted to bring up, it sounds like as these circumstances are playing out, we're going to see a depletion in above ground stocks to less than 3 months of supply. So I wonder if you can talk about that. How significant is that? Where are the stocks usually at, just so we have some context?
Well, I mean, I would start by saying that, kind of rule of thumb in commodity markets is anything less than about 6 months of demand in above ground stocks is considered to be fundamentally low. That said, we have to treat any kind of above ground stock estimate for the PGMs, because these numbers aren't reported. We have to treat them with a degree of caution. These are estimates. They're highly unlikely to be really, really accurate in terms of the amount of metal and so therefore the months of cover and so on. So I think it's important to kind of look at the trends in above ground stocks rather than the absolute level. What we do know is that they are depleted and they are low, and we can see that in those things. There's market tightness indicators that we've already discussed. And if we see the deficit this year, we'll see those continue to deplete, and so that's something that is probably going to be a bit of a concern for end users in terms of having confidence in market liquidity and so on through the balance of the year. I think we are seeing some like I said, with the Q1 outflows from ETFs and exchange stocks, we have seen a bit of an improvement of that liquidity profile for the time being, but not a complete elimination of market tightness. But certainly it's something that's going to keep the market, I think, probably on its toes really through the rest of the year, and will factor into value establishing sort of expectations and so on.
Another point that I wanted to bring up, the last time that we talked was toward the beginning of March. So the Iran war was really just beginning at that point. Now we've had this going on for a couple of months. How is that impacting the platinum market? Is there significant developments that you're seeing there? How are you looking at that?
Well, so far, like I said, we have downgraded slightly vehicle production forecasts for 2026. It really depends upon how long this conflict and the kind of second order impact that the closures of the Strait of Hormuz continues for. I would say that there is a further risk to demand the longer the conflict goes on. It's not just about oil and gas prices and energy prices and higher rate expectations, but it's also about things like Middle Eastern supply of automotive aluminium. So the Middle East produces around 20% of global aluminium ex-China. 84% of that output is specialty automotive alloys, and so that could, if we see that shortage persist, that could be a bit of a drag on automotive production numbers. We are seeing, or we've heard actually through the course of London Platinum Week, that quite a lot of the automakers have been much faster at shifting their supply chains than we were worried about. So that's encouraging, but fundamentally, that's the availability of those specialty alloys is a concern as time goes on. You've also got helium. So Qatar produces around a third of the world's helium supply. Helium is absolutely critical for producing high-end semiconductors. So a shortage of helium may result in some semiconductor production shortfalls, and that would potentially also impact vehicle production numbers. In terms of the impact, however, it's probably important to emphasize that the aluminium side of things is probably equally split between internal combustion engine hybrid vehicles and battery electric vehicles in terms of the impact. In terms of helium, there's a bit more of a skew to impacting battery electric vehicles because they tend to be more kind of chip hungry, if you like. And so that's probably where we'd see the bigger downside risk there. And of course, that doesn't impact platinum or palladium or rhodium demand.
On maybe a longer term basis, so the war is also creating a lot of concerns about energy supply chains, and platinum has the hydrogen technology element in there. Do you see any impact on that front in the longer term?
So, I think the longer term perspective from the war in Iran is what people have kind of been thinking about is, well, do higher gasoline and diesel prices mean that people are going to be pivoting more rapidly towards battery electrification? I'm not totally convinced that that's the case. In Europe, which is probably the market that's be most likely to see that sort of switch, there's a pretty strong correlation between oil and gas prices and electricity prices. So, is it necessarily more beneficial, more cost effective to switch to EVs? Not totally sure. In other geographies, China's got a regulated electricity market, so there you could see perhaps a faster adoption of battery electric vehicles. But overall, we're seeing the Chinese automotive market from a BEV perspective being, that's a battery electric vehicle perspective, being slightly weak actually through the first quarter of this year. The US obviously would be another possible market. You've got a slightly weaker link between oil and gas prices and electricity prices in the US than you do in Europe, but it's just not really a market that we see as being really enthusiastic about adopting battery electric vehicles. The current US administration has cancelled a lot of the tax incentives for switching to battery electric vehicles, for making those purchases. You've kind of got the drill, baby, drill kind of mantra that's being touted out there. And so actually, if anything, what we're seeing in the US is a bit of a pivot back towards bigger engine capacities. And so therefore, you need more PGMs in the exhaust treatment system. The other thing in the US is that we're seeing a bit of a slowing of some of the emissions control legislation. So this is in two areas. Firstly, there's a softening or delay to the fleet-wide CO2 reduction targets. Those targets would have been very supportive of automakers trying to produce and sell battery electric vehicles. That incentive has gone away, and so we see that being supportive for ICE and hybrid demand. And they're also delaying the implementation of Tier 4 emissions control legislation, which would have been similarly quite punitive in terms of actually would have required more PGMs in the vehicles. But we think automakers would probably have tried to accommodate that by focusing on BEVs rather than internal combustion engine vehicles, whether they're pure ICE or hybrids. So actually, some of these changes in the US are conversely actually quite supportive of higher for longer ICE demand and higher for longer demand for PGMs. There's one thing on the Iran war that I think is kind of fun to. It's war. It's not a fun situation, but it's kind of interesting to point out, which is you've got the FIFA World Cup kicking off in North America pretty soon. If Iran does compete and the US finishes third in its group and Iran finishes third in its group, then they could play each other on the 3rd of July, so the day before the 250th anniversary of US independence, which would be something interesting to watch. We could see the whole situation trying to be settled on the pitch, maybe.
That would definitely be very interesting. Yeah, we are getting ready for a World Cup in Vancouver right now. So, okay, that'll be a day to keep an eye on for sure. I wanted to at least bring up price briefly with you. I know that the World Platinum Investment Council isn't projecting prices, but it's been a pretty interesting time. You mentioned at the beginning of the year, platinum went way up like all the other precious metals, came back down. Now it's kind of found a holding pattern. Maybe the way to ask it is, are the themes that caused that spike at the beginning of the year, are those broadly still in place, or how are you seeing it? Have there been big changes?
No, I think you've asked the question in a very sort of neat way. Fundamentally, if we kind of anatomize the price rally, which started more or less 1 year ago from today, I would say that the kind of catalyst for starting the price rally was very much fundamentally driven. At the time we were in our third year of pretty sustained market deficits. You had extremely tight conditions in terms of elevated lease rates, strong backwardation in the London OTC market. You had the trade tensions with the United States. And you also actually had a change in the way that some end users were choosing to own platinum. So with the high lease rates, that was just proving to be economically punitive for them. So we saw people switch from leasing to ownership, so a fall off in leasing volumes, and that kind of reduced liquidity effectively in the market. The actual end demand for metal didn't really change particularly as a result of this, but there was just less metal cycling through the market. And so that kind of tightened the liquidity side of things. As the year unfolded, we saw a kind of shift, particularly going into the fourth quarter, towards the sort of sell America, sell US dollar sort of trade, pivot towards monetary-like assets. That benefited the whole of the precious metal complex. And really today, I think actually both of those factors are still there. You've still got a market deficit forecast for this year. So we've still got this very, very supportive fundamental outlook. You've still got tightness in the leasing market and the OTC market, and as I kind of alluded to earlier, you've still got potentially a return to this motivation to pivot away from the US dollar and treasuries towards monetary-like assets, including the entire precious metal complex, and of course platinum would be a significant beneficiary of that.
Well, I think that ties it all together quite nicely, unless there's any final points, thoughts that you would leave investors with as we're heading into, I guess, the second half of the year at this point.
Yeah, no, I think we've kind of covered everything. Just persistent deficits. There's a lot of tailwinds to think about in terms of potential future investment flows, and I think the fundamentals kind of speak for themselves. So it's an interesting outlook.
Definitely. We'll look forward to having you back later on. And for now, once again, I'm Charlotte McLeod with investingnews.com, and this is Edward Sterck with the World Platinum Investment Council.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.